it's like the Wizard of Oz. You got to peek behind the curtain, but I guess you have to find Oz before you get to peek behind the curtain, huh?
You do. Again, as I've said on previous shows, you've got to know what's on your credit report, because you don't want to apply for something if you know you're going to get turned down, because too many inquiries are going to lower your score even further. So I see too many people where over a weekend they've gone out car shopping, and it's the kiss of death for the next 6 months after that, because each dealer is going to pull up your credit report, 4 to 7 times. You get turned down, you go to another dealer thinking they're going to have something different. They all have the same 3 bureaus out there. So you can wind up having, 15, 16 inquiries on your credit report in one weekend.
And just screw the whole thing up. Well, in fact, a lot of businesses, a lot of people use credit in order to, grow their business, buy certain things, cars. And you had brought today the 4 C's of lending that are most important.
The 4 C's. Cash flow. Key is cash flow. If you have cash flow, then you're going to be looked at as a healthy business. Collateral. If you are in the restaurant business, let's say, and you have equipment and purchase orders and receivables coming in, and then business credit. If you have strong business credit, you're going to be able to get loans in the business community out there where you don't have to use the 4th C, personal credit. Your FICO score, and if you're going to be using your personal FICO score on your credit reports, you're going to wind up being a personal guarantor on that loan.
So when you start looking at these, let's start with cash flow just to kind of get into this, because a lot of this, at least from in the mortgage business, you can tell me if it's different in a lot of other areas. But when you start looking at cash flow, this has nothing to do with how much money is in the bank.
No.
This has much more to do with how much money you have coming in and how much you have going out and what's left over at the end of the day.
It makes a difference also if you have a merchant account and you take in debit and credit cards. A percentage of that can make a big difference on the cash flow coming in. If you bring it in, like I have a client who brings in over $200,000 in merchant account through credit cards at a pizza place. However,
sounds like a Papa John over there, huh?
However, the problem is that if you don't have a strong credit report to back that up, too many parking tickets, Alliance One, takes the score down. She can't get that advance that she wants to buy new
pizza making equipment.
That's right.
Tomatoes.
Tomato sauce.
So, David, when you talk about that cash flow, are there strategies, I suppose, to improve that when you're trying to get credit?
Well, you certainly can. I mean, if you're able to qualify for a business loan, you can improve your cash flow just by advertising. But it's kind of a catch-22. If you're desperate for money, you're not going to wind up getting it. The key is preparing ahead of time so that you have business loans available to you.
So not the day you need it, but knowing that line might be sitting there and really preparing in advance.
That's the biggest thing, I think, for most small business owners, because they tap out their personal line of credit. I have another client who's got perfect credit, but he's used 30,000 personal credit cards to fund his business. Subsequently, this day and age, the banks, every time you pay down on your balances, the banks are lowering your balances. So it looks like he's always tapped out. And the higher the credit limit is and the higher the available balance, you're going to wind up with a lower credit score. So I've advised him to get his business credit in order so that he can get a line of credit, pay off his personal. His score is going to go up by 50, 70 points.
David Murphy joins us with Credit Insider Club. David, when you talk about business credit in particular, it is different. You talk about credit going up 50 points. How does somebody even go about establishing business credit from the very beginning? Because your personal credit's pretty easy. You go to somewhere, they try to give you a credit card, you sign up for a credit card, and then you have credit. I mean, it all kind of ties itself together with a pretty even and easy. It works. It just does it. Business credit's a little different, isn't it?
Actually, business credit, you can establish business credit quicker than you can personal credit. But you've got to do it the right way. I mean, first off, you got to get yourself a DUNS number. All right? DUNS stands for Data Universal Numbering System.
And those are like, what, $300 or something?
It's even more expensive than that. There are ways of getting it for free. Of course, just like Equifax and Experian and TransUnion, they're pushing product. They want you to buy their product.
Sure.
You get a DUNS number. The key is to get several net 30 vendors and then some revolving vendors. But it's a step-by-step approach. There's over 500,000 companies out there that will extend lines of credit to you. But the problem is less than 6,000 of them report to Dun & Bradstreet, Equifax, Experian, and that's the ticket. You want the reporting.
Like the pawn shop. Pawn shop probably not reporting to
Probably not.
When you're going, all right, hold this diamond ring for a little bit. I'll get you back. Probably not where where you're looking to establish credit.
You establish several accounts, 3 to 5 net 30 accounts. You use those accounts month in, month out, whether you're buying a stapler or a hammer or what, whether it's Lowe's or Staples. Then you build a successful business credit report. Unlike personal credit, you get bonus points for paying ahead of time. And that's the key to success, building business credit. Not paying as agreed, paying in advance. So you have net 30 accounts, people wait until the end of the month to pay the bill. If you're paying 2 weeks in advance, then that shows up as an indicator.
So really just, it doesn't matter how much. I mean, if you're a small business and like you said, you go buy Staples or something.
Yeah, you could buy a stapler.
For $5 or whatnot.
As long as you get the bill, you pay it ahead of time, you're going to start accruing the Paydex score, which goes from 0 to 100. So if the equivalent of a high FICO score would be 750, 100 is equivalent to that in the Paydex score with Dun & Bradstreet. You want to be between 80 and 100. 90 to 100 is going to get you a loan.
Yeah. And then talk a little bit more, and we just have about a minute and a half left here. We're here with David Murphy, Director of Operations with Credit Insider Club. But talk a little bit more about how to maybe keep your personal credit out of it. Because, a lot of people in business, they're thinking, well, I have to personally guarantee that loan. Not maybe a good idea, but how do you really make sure that that isn't a path you have to go down?
Well, here's the deal. If you establish business credit, then you're going to be able to get the loans through the business. If you don't establish it, you're always going to wind up being the guarantor. All right? It's the small business owner who's an LLC or a C Corp. They have the ability to use their business credit for business loans, real estate, vehicles. You can run that all through there without being the guarantor. But if you're stuck with your credit report, and the banks aren't going to tell you this because they're going to sell their product too.
Sure.
That's what.
And they'd rather have you personally guarantee it,
definitely.
of course.
Definitely. The whole idea is to know when you apply for a loan, if you know what the lenders are looking for, then you can apply that way. And if you know what they're going to look for, it's much easier to get the loan. So you present your credit report, your business credit report, like you would when you're applying for a job.
Yeah.
With a resume, because this is your financial resume.
Well, David, all makes a lot of sense. And knowing what the underwriters are going to look for, as you say, it makes it a successful process. And then, of course, knowing those 4 C's of lending, the cash flow, collateral, business credit, and personal credit are all great tips.